Hello, Namaste. In today's video, I am analyzing HPCL, Hindustan Petroleum Corporation Limited. We will begin by analyzing the company's profile, what it does, and then we'll move on to analyzing the financial statement and the graph as well as the intrinsic value. That is, we'll analyze the fundamental as well as technical. So beginning with the company's overall profile, what it does, this has a strategic importance in the domestic energy sector. Government of India has a large and indirect ownership in HPCL via ONGC. It has an established brand name and position in the domestic oil refining and marketing business. HPCL's strong parentage through majority ownership by ONGC, which has a 51.11% stake in HPCL, and also its strategic importance to the Government of India, given the company's role as the Government of India's extended arm for policy implementation. HPCL operates 3 refineries: the Bhatinda refinery of HPCL-Mittal Energy Limited joint venture, in which HPCL's stake is 48.9%, had a total combined capacity of 27.1 million metric tons MMT and a sales volume of 38.7 MMT in FY19, basically translating into the oil refining market share of about 10.9%. The company had around 16,000 retail outlets and 6,040 LPG distributorships as of December 2019. Fuel retailing in India has largely remained dominated by IOCL, BPCL and HPCL. The recent move by government to privatize one of the OMCs, that is BPCL, could alter the market structure. Any deterioration in ONGC's credit profile may have an impact on HPCL. As of December 2019, HPCL's standalone cash and cash equivalents and current investments in the form of GOI special bonds increased to INR 62.7 billion, which was in the previous year 51.6 billion. The company has short-term limits amounting to 457.5 billion INR, which also includes USD 1 billion revolving line of credit. Basically, company has a good credit profile. Of the total debt outstanding of INR 285.9 billion as of December 2019, around 55% was forex dominated. Basically, what it means is that 55% of the debt is coming from abroad or from foreign countries, and about 74.9% of the total outstanding debt comprises term debt with repayment of 40.3 billion INR due in FY21. Basically, the company's major debt is composed of fixed tenures, and in FY21 it has to pay 40.3 billion. HPCL has a strong financial flexibility given its access to diversified sources of funds. Its short-term borrowings reduced to 71.8 billion from 137.9 billion as of December 2019 because the company received subsidy dues from the Government of India. HPCL plans to incur capital expenditure of about 663 billion INR over 2024 fiscal year on expanding its refinery capacity, meeting new emission standards, increasing its pipeline network, city gas projects and a petroleum complex. HPCL is also setting up a 9 MMT refinery in Barmer through a 74/26 joint venture with the Rajasthan government. Its capacity enhancements and upgrade projects in Mumbai from 2 MMT to 9.5 MMT and Visakhapatnam up from 6.7 MMT to 15 MMT will be completed by FY estimated 20 and FY estimated 21-22 for both Mumbai and Visakhapatnam, thereby boosting its refining capacity by 54%. HPCL's standalone 9-month FY20, that is up till December 2019, annualized net leverage is basically debt minus cash divided by the operating EBITDA increased to 2.9 times. Previously it was 1.9 times. That is, the debt to EBITDA increased from its previous year, and the total gross interest coverage, that is EBITDA divided by gross interest expenses, reduced to 7.8 times from 15.8, largely driven by a decline in the EBITDA margin to 3%. Previously it was 4.2%. High dividend of 17.2 billion Indian rupees and significant ongoing capex. So all these have resulted in the company's standalone debt to EBITDA increasing to 2.9 times, and therefore interest coverage dropping to 7.8 times. HPCL's credit profile will see a marginal improvement in the fourth quarter FY20, driven by higher EBITDA generation on account of better GRMs. Capex outflows for the transition to Bharat Stage 6 emission norms and the expansion of refining capacity will prevent any meaningful decline in the leverage. That is, the overall debt is expected to remain at this level because of the ongoing expansion of refining capacity as well as moving to Bharat Stage 6 emission norms. Despite around 5.1% YOY growth in the marketing volumes, including the exports, to 30.1 MMT during 9-month FY20, HPCL reported a 2.2% YOY decline in the consolidated revenue to 2,028.4 billion Indian rupees on account of a planned shutdown in Mumbai and Visakhapatnam refineries, which led to a decline in refinery throughput to 12.6 MMT. Now what is happening here is the company had a planned shutdown in both Mumbai and Visakhapatnam refineries, and therefore from 30.1 MMT the overall output has decreased to 12.6 MMT. HPCL's margins will be vulnerable to the risk of growing competition from private players and also subsidy sharing or fuel price caps or inadequate and untimely price hikes on deregulated products. So all these are negatives for the company. The fall in the gross refining margins was caused by volatility in the crude oil prices, leading to an inventory loss of 0.6/BBL in 9-month FY20 as against an inventory loss of $0.2 per BBL in 9-month FY19, and at the same time there was an inventory gain of 1.6 per BBL in FY19. So what is happening here is that the company's overall GRM has fallen due to the volatility in when it purchases crude oil and when it refines and sells it back. So overall, when it had purchased the crude oil, it may have been at a higher price, and later on the crude oil prices have fallen and therefore it cannot sell at a higher rate, and thus inventory loss for the company. And also lower average cracks of products, mainly petrol and LNG. In this second part, what is happening is that the company has to convert crude oil into petrol and LPG, and that process is known as cracking. How much of the crude oil or what percentage of the crude oil is actually getting converted into petroleum and LPG products. So that has also lowered. The GRMs are likely to improve in fourth quarter FY20 by increasing crack spread on diesels. That is, that they will try to improve the overall conversion of crude oil into petroleum and LPG products, supported by the International Marine Organization's regulation and normalization of the petrol spreads, a decline in specific energy consumption, and an improvement in crude sourcing mix. All these the company is doing in terms of increasing its overall crack spread. Petrol spreads continue to be susceptible to the overall risk of lower petrol demand, driven by increased adoption of electric vehicles and use of alternatives such as compressed natural gas and liquefied natural gas. So company's risk is in the terms of lower petrol demand in the future, and if electrical vehicles are used on a higher scale, that also is a risk for this company. HPCL remains vulnerable to government policies with regard to subsidy sharing and fuel price change, global refining margin cycle, crude oil price volatility, forex rates, and rising competition in the domestic market. Again, all of these are also a negative for the HPCL if these things do come up, and they do generally happen very frequently. HPCL is a public sector undertaking that operates as a refinery and an oil marketing company. The company had an annual turnover of 2.7 trillion rupees in FY19, whereas in the previous year of FY18 it was 2.2 trillion rupees. It operates two refineries, one each in Mumbai, which has a capacity of 7.5 MMT, and Visakhapatnam, which has a capacity of 8.3 MMT, producing a wide variety of petroleum fuels and specialties. It holds an equity stake of 16.95% in Mangalore Refinery and Petrochemicals Limited, located in Mangalore, and has a capacity of 9 MMT. So this concludes my analysis of the company's profile. Now let's check out the company's financial statements, including the annual profit and loss account, balance sheet, cash flow statement, and the quarterly profit and loss account. Let's begin our analysis of HPCL's profit and loss account analysis. We'll begin with the sales growth rate compounded over 3 years and the latest 2019 to the recent 12 months. We have seen a slight fall in the recent 12 months in terms of revenue generated through sales to 2,70,851 crores. In March 16, the overall sales had dropped from March 14 to 1,77,910 crores. Although from 16 to 19, which is a 3-year period that we are analyzing, it has grown by 15.6%, and in the last 5 years the sales growth compounded is 3.3%. If you don't understand any of these ratios, do let me know in the comment section and I'll try to clear the doubt. Alternatively, you may watch my earlier videos in which I have explained in detail in all my videos what these ratios mean and how to understand them and analyze them. I have tried to make all my videos complete in themselves so that you don't need to go and watch another video to understand what these ratios mean. But in case if you want to understand in detail, then you may watch my other videos. Average OPM over 5 years was around 4.3, and in the last 3 years it was 4.9%. The operating margin has always been very low, below 5%. Let us look at how much is the operating expenses. The operating expenses is 2,63,000 against the total sales of 2,75,000. So a very high expenses because the company is trading in high volumes, therefore its margin would be low. In the recent 12 months also, it has kept its OPM at around 4.1%, very near to where it was in March 19, slightly dipped than March 19. Other income contributed around 2,395 crores to the total sales, which is just less than 1%. Even in March 19 it was a similar case, and March 16 it was 1.1%. So the company's other income is not contributing much to the total sales. Depreciation, if you look, that too is a very small amount compared to the overall sales it is generating. The total depreciation is 3,383 crores in the recent 12 months, which translates to just 1.2%. Raw material cost is the major portion which is occupying the total sales. That is, 90% of the expenses are in the raw material cost of for the company in March 19, and it has always been very high throughout. In March 16, the overall raw material cost had declined to 88%, but now again it has increased to 90%. Employee cost as a percentage of total sales has always been very low at below 2%. In March 19, it was just 1.08%. Interest expenses were just 991 crores in the recent 12 months, which basically translates to just 0.4% of the total sales of 2,70,851 crores in the recent 12 months. And if you see throughout, the numbers are very stable at 0.4%, 0.3% in March 16 and 19. Tax rate, if you look, the company has been paying above 30% of tax rate throughout these 5-6 years that we are analyzing. What I've done here is I have used data from March 16, March 19 and the recent 12 months. So the tax structure is very stable throughout these years. Interest coverage is 10 times in the recent 12 months, which means the EBIT, which is 10,085 crores. This is the top line profit, earnings before interest and tax. So to calculate this, in the operating profit we add other income and deduct depreciation cost and we get EBIT. So on the total EBIT of 10,085 crores, the company has paid an interest of 991 CR, which works out to around 10.2 times. This is a good multiple throughout the years. Net profit margin is very low throughout March 16, March 19 and the recent 12 months. The profit margin on the total sales has been very low at below 3% throughout. But when we look in terms of volume that the company is generating, in that sense it is true that the overall NPM margin will always be very low. We also need to look at how the other peer group companies are doing in terms of NPM margin. If we look at the average NPM of 5 years and last 3 years, we see it was always below 4% on an average, and in the recent 12 months the NPM margin has fallen below both its averages. Let's look at how the net profit has grown over the years. In the recent 12 months, the net profit has fallen by 10.2% over March 19, from 6,691 crores earned as net profit in March 19. The current net profit is at 6,006 crores, which is a 10.2% shortfall. In the last 3 years and 5 years, there is a positive growth rate in the net profit at 44% in the last 5 years and 12.7% in the last 3 years, which is a good figure. Valuation ratio market cap to sales. Here the sales is very high at 2,70,851 crores compared to what the company is valued in the market at 25,995 crores. So the company has a very high sales compared to its market cap, and throughout if you look at the values, it has always been at 0.1 times, 0.2 times and so on. The company's dividend payout is very high throughout the years at above 25%. In March 19, 36.2% of the total profits were given out as dividend. The total profits were 6,691 crores and 2,423 crores was given out as dividend, and we see that the amount of dividend the company has paid in 14 to 16 to 19 has been increasing steadily as the net profit has been increasing also. The current price earning is at 4.3 times, meaning the price of the company at 170 rupees is 4.3 times higher than the earnings of the company. What we have to look here is that the earnings per share EPS has to be increasing throughout the years. In March 16, the company's EPS that is earnings per share was 30 rupees. In 19 it became 43. Now in the recent 12 months, because the profit has fallen, therefore the earnings per share will also drop, and the current EPS is at 39.4. To earn this profit of 39.4 rupees per share, we have to pay 170, and therefore the multiple is at 4.3 times. Now this multiple is much below March 16 and March 19 values, so we are getting it at a lower valuation. If we look at the average of last 5 and 3 years, the current price earning multiple is going at a discount to its averages. Moving on to the balance sheet analysis, the equity share capital from March 16 to March 19 has increased exponentially. This also needs to be investigated. In between March 16 and March 19, ONGC acquired HPCL, and therefore the overall share capital has increased to 1,524 crores. But still this needs to be investigated. The face value of each share is intact at 10 rupees. Return on equity in March 19 was at around 22%, a very high percentage. The total net worth of the company was 30,000 crores, which is the shareholders' contribution into the business. On that, the total net profit earned was 6,600 crores, which works out to around 22%. In March 16, the ROE was quite high at 28.1%, but in 14 it was very low at 7.7%. So the company's profits have increased exponentially from 14 to 16, and the overall net worth also has increased, and therefore the ROE. If you look at the averages of the ROE for 7-year period, 5-year and 3-year period, we see above 15% of ROE generated on the shareholders' money. Return on capital employed looks at what is the total source of fund the company has, or total capital employed into the business, and on that what is the EBIT it is generating. So in March 19, 18.5% of ROCE was generated on the total capital employed of 58,592 crores. That is an EBIT of 10,825 crores. In March 16, the ROCE was 19.2%, whereas in March 14 it was low at 6%. If we look at its averages, then for all the different years that we have, it was always above 15%, and that is also my benchmark. Return on total assets was flat at 6% in March 16 and March 19, whereas in March 14 it was quite low at 1.1%. This ratio measures what profit the company earned on the total balance sheet size. Debt to equity ratio in March 19 stood at 0.9 times. That is, the overall debt and the equity contribution into the business was almost equal. And if we look from March 14 to March 16, the overall debt to equity ratio has reduced, and currently it is at 0.9 times. So this is a good trend. If we look at the individual debt position, in March 14 the total debt was around 47,000 crores, which has been brought down to 28,000 crores in March 19, whereas the equity has increased from 13,000 crores to 30,000 crores. So this gives us a comfort that the company is managing its debt to equity ratio well. Now, thing to understand here is this is the consolidated analysis of the financial statement. We are not looking at a standalone statement, and therefore this numbers would include the values of its subsidiaries, associates and sister concerns. Let us look at the equity contribution and debt contribution to the total assets. We have already seen this ratio in the previous one, debt to equity, but let us quickly glance through that. In March 19, equity contributed around 28% to the total balance sheet size, and the debt contributed around 26%. So it is almost equal or nearby to ratio of 1. In March 16 it was 24:31, and in March 14 it was 14:48, and the balance was other liabilities. So as of now the company's debt to equity ratio is comfortable. Earlier we saw that the company had a very good interest coverage ratio, and therefore this debt to equity is comfortable as of now. In terms of price to book ratio, we see that the company's net worth was 30,000 crores, and the company's current market cap has fallen below its net worth. So we are getting it at a discount to its net worth. Current price to book is 0.9 times, and it has fallen from March 16, where it was trading at 1.6 times and 1.4 times in March 19. In terms of how much the company's debt is compared to the net profit it is earning, in March 19 the overall debt was 4.21 times higher than its net profit, and this is a comfortable zone because we don't want the company to have a high debt and not earning profit against that. Here the position is quite comfortable. In March 14 the debt was 47,000 crores, against which the company had earned only 1,080 crores. That's a 44 times multiple, which within 3 years the company has reduced to 4 times. That is, not only this the debt gone down, but the overall net profit has gone up. Let us look at the net block, that is net assets of the company out of the total assets of the company. In March 19, 38% of the total balance sheet was in fixed assets. So company has a fixed assets of around 41,000 crores. These are the net assets, that is total assets minus depreciation. In March 16 it was 47.7%, and in March 14 the total assets or fixed assets of the company were 39.3%. So the company has managed to keep its net block at a decent percentage or a very stable percentage, although this is quite high, but the company is capital intensive in nature and therefore would have high asset base. Let's move on and look at the current work in progress, that is how much work was going on into building new assets for the company. In March 19, 9,519 crores of work was going on in the business, which works out to around 8.8%. This ratio indicates that the company is incurring capital expenditure to build new assets, which is just 8.8% of the total balance sheet. So this is still within a reasonable percentage. Investments of the company has been increasing throughout the years. Currently in March 19 it stood at around 14,200 crores of the total balance sheet size, which works out to around 13.3%. We see percentage wise the overall investments are going up. The debtors as a percentage of total assets occupied around 5.3%, and that has remained flat at around that range only. In March 19, out of the total assets of 1,07,000 crores, company's debtors stood at 5,667 crores. This is the amount the company has to collect from its customers or debtors or accounts receivables. Moving on to the debtors turnover, this measures against the sales of 2019 how much was to be collected from the customers. Looking at the number from balance sheet, we see that 5,600 crores was to be collected from the customers against total sales of 2,75,000 crores, which is a mere 2%, which is a small figure considering that the company collects payment from its customers within 8 days. So it has a very tight control over how much days it gives to its customers. Even in March 16 we see that the company collected payment from its customers within 8 days, and in 14 also it was approximately around 10 days. So the number of days has fallen from 14 to 16, and that's a good sign. Not only are the debtors to sales ratio very low, but the amount of days it is collecting its payments from customers is also very low. The company's cash holding is very low. In March 19, only 219 crores were left as cash into the business. In March 14, the value was quite high at 2,100 crores. Considering the percentage wise it was low, but value wise it has been dropping, and the company's cash position as of March 19 was a very low 219 crores. In terms of current ratio, the current liabilities in March 19 exceeded the current assets, which means the company's overall ratio dropped below 1 times, which is my benchmark. In March 16 also, the company's current ratio was 0.8 times. Here we want the current assets and current liabilities to be almost equal, or current assets to be more than the current liabilities. This means that the company's liquidity position is good. Company's inventory holding as of March 19 was 20,000 crores and very near to where it was in March 14. Compared to the total balance sheet of 1,07,000 crores, which works out to around 19%. So this is a comfortable percentage for me. Anything above 30% of inventory holding against the total assets of the company is a sign that the company is holding too much inventory. The company's sales to inventory ratio, that is inventory turnover, looks at how much sales the company did against the inventory holding in its balance sheet. In March 2019, the sales were 13.5 times higher than the inventory holding. If we look at the multiple throughout the years, it always had a very high multiple of inventory turnover. So we want this to be as high as possible. Moving on to the cash flow statement analysis. In March 19, the company's total profit was 6,600 crores. Against that, the cash coming in was 8,500 crores. A 28% higher cash received against the profit declared. So in this ratio, what we are looking for is that if the company has declared a certain profit, is it receiving that profit in cash, that is from operating activity. So out of the 6,691 crores, the company has received 8,554 crores as cash. And if you look at all the trend of the previous years, we see a higher cash inflows against the net profit declared. So this is a good value. If you look at the long-term trend of 3 years, 5 years and 7 years, here too the amount of cash inflows have always been more than the net profit declared. So in last 3 years, the total profit declared was around 22,000 crores. On that, the company's cash inflows were around almost 30,000, which is a 35% higher cash inflows than the net profit. Similar is the case for 5 and 7 years. Out of this cash earned, how much was put into investing activity? In March 19, the company's cash from operating activity was 8,500 crores. Of that, the company invested almost everything, and over and above that, 33% additional was invested. That is 11,382 crores was put into investing activity. This investing activity includes buying of assets as well as investments in mutual funds and shares. But in March 14 and 16, the company's overall investments was at 74 and 64%, a decent comfortable zone for me. But in March 19, an excess investments were done against the cash received through operating activity. Let us look at the long-term trend of cash flow from operations to cash flow in investing activity. That is how much was put in the long term of the total cash earned from operating activity into investing activity. So we see that it was always at a high percentage, but within the cash earning capacity of the company. That is, in the last 3 years, 81% of the cash earned through operating activity was invested in the investing activity. Now, in the last 5 years and 7 years, the company's investment percentages were above 60. Finally, let's recap the valuation ratios. Current price earning is 4.3, price to cash is 3 times, and price to book is at a discount of 0.9 times, and the market cap to sales is a very good 0.1 times. So currently we are getting it at a very good valuation, at least fundamentally. Let's quickly analyze the quarterly profit and loss account. The sales YOY has dropped by 1.9%, whereas in quarter on quarter it has gone up by 16.2%. Profits has increased by 167% over December 2018. This needs to be understood as to why the profit in December 19 has jumped to 1,027 crores. Quarter on quarter also we see a 34.9% growth from September 19 to December 19. So overall the trend is positive. NPM throughout has been very low on the total sales. In September 19, the company's NPM was 1.2%, and in December 19, company earned 1,000 crores of profit against the total sales of 70,820 crores. So this concludes my analysis of the financial statements of HPCL. So in this part of the video, I am comparing HPCL with its peer group Reliance Industries and Indian Oil Corporation Limited. The current price is 170 rupees for HPCL, 1065 for Reliance and 76 rupees for IOCL. The data for all these three companies are up to date till December 2019. Let us look at the growth in sales YOY for all the three companies. We see a degrowth in all the three companies. with IOCL showing the highest degrowth in its sales YOY in the quarterly analysis. Reliance Industries revenue through sales dropped by 2.52%, whereas HPCL dropped lowest at 1.9%. In terms of profit growth YOY, we see a positive growth in profits for all the three companies, with IOCL registering the highest growth in terms of percentage from its previous quarter at 178%. HPCL showing a growth of around 167% from 384 crores in 2018 to 1027 crores in 2019 December. Reliance Industries showed a growth of around 14.9%. If we analyze the recent 12-month sales with the sales in 2019, we see that HPCL's entire sales for 2019 was 2,75,000 crores. Compared to that, in the recent 12 months also, it has managed to generate around 2,70,851 crores in its sales. So it is very nearby to the 2019 sales value. Same is the case for Reliance Industries, generating around 5,97,000 against 5,66,263 crores earned in 2019. IOCL generated around slightly less than what it did in 2019. If you look at the profit in the recent 12 months, comparing it with 2019, the HPCL's profit has reduced to 6,000 crores in the recent 12 months compared to 2019 value. Reliance Industries profits in the recent 12 months has increased to 43,000 crores from 39,000, whereas IOCL's profits have fallen to 12,000 from 17,000 CR. So both HPCL and IOCL have seen their profits decreasing from 2019 values. Looking at the 2019 profit and how much cash the company received against that profit, HPCL has received higher cash of 8,500 crores against the total profit of 6,600. Reliance Industries profits have also increased to 39,000 crores and the cash coming in against that is 45,000. So higher cash for Reliance also. IOCL has seen a lower cash of 14,000 against the profit declared of 17,000 crores. So only IOCL has received less cash than the profit declared. In terms of how much fall each company has seen from its respective 52-week highest point or last 1 year's highest point the stock had reached, the highest fall was seen for IOCL at 54%, followed by HPCL at 48% and Reliance at 34%. So almost all of these companies have seen more than 30% of fall from 52-week highest point. HPCL is currently available at 4.3 times price earning, the lowest in the group. Reliance Industries is trading at 15 times its earnings and IOCL at 5.6 times. Both IOCL and HPCL are trading at below their averages of 5 years and 3 years. Reliance Industries is also very near to its average but slightly more than what it was available in the 5 and 3 years period. Price to operating cash flow for HPCL is 3 times. This is also very reasonable. Reliance Industries price to OCF is high at 14 times and IOCL is quoting at around 5 times its cash earnings. Price to book value wise, HPCL and IOCL both are trading at a discount to its net worth. HPCL's price to book is 0.8 times, whereas IOCL is 0.6, lower than HPCL. Reliance Industries is still trading at a premium to its net worth. In terms of PG, in fact all three companies are trading at a good price earning to growth multiple. Not only are their price to earning multiple low, but their growth in profits over 5-year and 3-year period are also high. Sales are growing in a positive trend for all the three companies. HPCL's last 5 years growth in sales was 3.3%. Reliance Industries at 5.4%, highest in the group. IOCL lowest at 1.58%. In last 3 years, all the three companies had a double-digit growth in their revenue through sales. Return on equity was highest for HPCL at 23.8%, followed by IOCL at 15.3%. Reliance Industries has shown the lowest ROE at 11.6%. Compared to their averages, Reliance Industries was giving around 12% ROE since last 5 and 3 years. Comparing that with HPCL, in last 5 and 3 years also the return on equity was very high at 28 and 31%. IOCL's return on equity over 5 and 3 years period was at 15.9 and 18.7, above the 15% benchmark that I have set. In terms of return on capital employed, again HPCL has generated the highest ROCE in 2019 of 20%, followed by IOCL at 15.8 and Reliance Industries at 11.6. When we look at their averages also, HPCL has generated highest ROCE over both 5 and 3 years average periods, followed by IOCL. Reliance Industries had a low return on capital employed of 10 and 11%. Return on assets was also highest for HPCL at 12.5% and average stood at around 11.4%. This is the amount of profit the company generated on the total assets. Asset turnover also was highest for HPCL. This measures how much sales was done against the total assets of the company. So this shows efficiency in converting the assets into sales. The higher the multiple, the better it is. IOCL managed a 2.5 times higher sales than the assets. Reliance Industries' asset turnover was low, which signifies that the company's assets are huge compared to the sales it is doing. Inventory turnover was highest again for HPCL at 14 times, which means the company's inventory holding and the sales comparison shows that sales is 14 times higher than the inventory. Both Reliance and IOCL are also converting their inventory into sales at around 8.8 and 7.1 times respectively. Let us look at the 5 years picture in terms of profit declared and how much cash it is earning, and of that cash how much is free cash flow. HPCL's 5 years profits were around 28,000 crores. Of that, 55,907 crores was received in cash and 20,000 is left over as free cash. So the balance of the two, that is 55 minus 20, approximately around 35,000 crores was invested in purchase of assets, and the balance 20,000 is left free for distribution in financing activity. Reliance Industries on the other hand has shown a profit of 1,57,000 crores and cash received of 2,39,000, but I have a negative free cash flow. I generally don't like to enter into a company which has a negative free cash, which means not only has the company invested entire 2,39,000 crores into the business, but over and above that it has invested 1,12,000 additional cash to buy assets. IOCL has shown a profit of 74,000 crores and received cash of 1,43,000, almost double of the profit declared. Of that cash earned, almost 1,13,000 crores is still lying free for distribution in the financing activity. Average profit of HPCL over a period of 5 years stood at around 5,600 crores. Compared with that, Reliance average profit was around 31,000 crores and IOCL at 14,000 crores. So when we look at these three companies, we see HPCL is quite small compared to Reliance Industries and IOCL in terms of generating profits. Market cap of HPCL is at 25,000 crores and net worth at 30,000. So their price to book value is going at a discount. Reliance Industries market cap is 6,75,000 crores and the net worth is 4,05,000 crores. IOCL's market cap is 72,000 crores and net worth at 1,13,000. IOCL is also trading at a discount to its book value. So Reliance Industries is the largest company of the three, followed by IOCL. Contingent liability position stood at around 6,000 crores approximately. Of the net worth of 30,000 crores, that works out to approximately 20%, which is a good value. I don't want the contingent liability to exceed 20% of the net worth. Reliance Industries overall contingent liability was around 27,000 crores, also a small amount compared to the net worth it is at. IOCL also had a comfortable contingent liability position compared to its net worth. So all the three companies' contingent liability is at a reasonable level. HPCL's debt to equity ratio stood at 0.94 times, Reliance Industries at 0.62 and IOCL at 0.78. All the three companies are below debt to equity of 1 times. Highest debt to equity was for HPCL. Let us look at the interest coverage. HPCL had maintained the highest coverage of 10.18 times, whereas Reliance Industries had the lowest at 3.8 times, which means at even this debt to equity ratio of 0.6, the company's interest outflow is huge. IOCL has managed to keep its coverage above 4 times, which is my benchmark. So even at a high debt to equity of 0.94, HPCL has managed to keep its EBIT at around 10 times more than the finance cost it is paying. Promoter holding in all the three companies are high at above 50% except for Reliance at 48%. None of the promoters of these companies have pledged their shares. The debtors to sales ratio for all the three companies are very low at less than 4% of sales. All these three companies are collecting payment from their customers very quickly. Reliance Industries is taking around 20 days, IOCL around 10 days, and HPCL is collecting at the fastest number of days of 7.5 from its customers. Net profit margin for all these three companies is very low. Reliance Industries is receiving the highest profit margin on their sales of around 7% in 2019, and the lowest NPM was for HPCL at 2.43%. At current price, the highest dividend yield was given by IOCL at 11%. If anybody buys at the current price, considering the dividend paid last year, they can expect an 11.73% return on their shareholding. HPCL is providing a dividend yield of 9.34%, again a high value, whereas Reliance Industries is giving the lowest yield at the current price. So this concludes my peer group analysis of these three companies. Let's move on and look at the technical chart of HPCL. Let us look at the technical chart of HPCL and understand where we can buy at or at what levels we can buy into this company. Currently, the RSI which I look at to start my buying, the week ended 27th March 2020 showed that the RSI or relative strength index line has fallen below line 30, which is my starting point to buy into the company. This is a weekly chart, so my buying was supposed to start at 170 and I can buy both upside and downside. The resistance and support lines that I've drawn on the screen tells me that I can buy at 145, 120 rupees going down, and 90 rupees and 75. These are my 4 levels downside from 170, and upside I can go for 190, 215 and 240. These are the levels that I have based on the support and resistance line. The price of 320 I don't expect anyone to buy, and going down I would break up whatever I want to invest into multiple parts and spread it out over these lines. So this is my technical analysis, and on that basis I'll read out the values that if someone is interested, they can put their money at these price levels and buy and wait patiently for the price to move. The price levels are 240, 215, 190, 170, 145, 120, 90 rupees and 75 rupees. So you can break up your investment value over these lines or over these price points and buy in a staggered manner. So this concludes my analysis of the technical chart. If you have any queries about the technical part, do let me know in the comment section. Let us look at the intrinsic price calculation the current price is 170.25 rupees. I expect that on the higher side the prices will reach 274 and 246 rupees, which is 61.3% gain from the current price and 44.5% gain from the current price. If we take these two values on the upper end as our target for selling, and if you want to buy, we have to buy at around 138.9 rupees and 155.3 rupees. These are the lower levels for entry and the upper ones are for exit. So if you look at from the bottom price, that is 138.9 and 155.3 rupees, we tend to gain around 97% and 76%, considering that we'll be selling at 274 rupees if we buy at 138.9 rupees or 155.3 rupees. The average of all these four intrinsic values works out to around 203 rupees, and the current price is 170, which means the current price is 16.4% below its average intrinsic value. So this is my understanding of fundamentally where we can buy. So we can buy at these three price levels of 138.9, 155.3 and 203.7, and the upward position to sell is 246 and 274 rupees. Whatever an investor is comfortable with, they can choose where they want to sell and where they want to buy. Calculation of intrinsic price is by taking the overall growth in sales, profits, cash flow from operations and the balance sheet size over a period of 5 years and 3 years, and projecting that growth rate onto the price from the base year. Thank you for watching this video. If you have any comments, suggestions, queries, do write in and let me know.